Global liquidity may have just changed direction. While most investors are focused on SpaceX, Nvidia, and the Federal Reserve, I think the biggest story in the market right now is happening thousands of miles away in Japan. And if you're holding leverage ETFs, growth stocks, or even broad market index funds, you need to understand what is happening because it could determine where markets go for the rest of the year. Welcome back to Lunch Money Investing for your Wednesday, June 17th midweek check-in. Today, we're covering the return of the yen carry trade unwind, Nvidia's massive capital raise, the latest developments surrounding SpaceX, the Federal Reserve's historic policy shift, and of course, how the lunch money investing portfolio is navigating all of it. Let's jump right into the portfolio with a quick portfolio update. Today, the lunch money investing portfolio closed at $2,383, down 1.57% for the day. That translates to a decline of $38.14. But here's the most important part investors are ignoring. We also invested another $13 today, bringing the total capital deployed this week to $73.52. While many investors are pulling back because of market volatility, our strategy is doing exactly what it's designed to do. We're continuing to accumulate shares of leverage index funds regardless of short-term price action. The entire premise of this portfolio is very simple. Volatility is not the enemy. Volatility is the mechanism that allows us to accumulate more shares at lower prices. The question isn't whether markets will be volatile. The question is whether we will have the discipline to continue buying during that volatility. And that brings us to what I believe is the most important market story right now, the yen carry trade. So most investors are talking about SpaceX, some are focused on Nvidia, others are waiting for the Federal Reserve, rightly so, it's important stuff. But I think the most important development this week came from Japan. On Monday, the Bank of Japan raised interest rates to 1% from 0.75%. On the surface, that doesn't sound like a major event. After all, US Treasury yields remain significantly higher than that, with the US 10-year trading at 4.45% and the Fed funds rate hovering between 3.5 and 3.75. The significance isn't the level, it's the direction. For nearly 2 decades, Japan has been one of the world's largest providers of financial liquidity. Institutions could borrow Japanese yen at extremely low interest rates, convert that money into US dollars, and invest into higher yielding assets around the world. This became known as the yen carry trade. And that money went everywhere: technology stocks, corporate bonds, private equity, real estate, venture capital. If it was a risk asset, yen funded money probably found its way there at some point. As long as the Japanese rates remained near zero and the yen remained weak, the strategy worked beautifully. But now the math is changing, with the Japanese yields at their highest levels in 30 years. When Japan raises rates, the cost of borrowing rises, and that has a knock-on effect on the yen. When the yen strengthens, existing yen-denominated debt becomes more expensive to repay. That creates a squeeze. And when leverage investors get squeezed, they often have to sell assets to reduce risk. That's why I think investors should pay close attention to Japan right now, because this isn't just a Japanese story, it's a global liquidity story. And global liquidity is the fuel that powers risk assets. Now, adding another layer to the macro picture, markets also reacted to the preliminary peace framework announced between the United States and Iran. The agreement establishes a 60-day ceasefire extension, while negotiators work towards a more comprehensive settlement. The initial memorandum of understanding was just signed a few hours ago, and now the real negotiations will take place. Markets immediately focused on the energy implications. Oil prices fell roughly 5% as investors anticipated increased Iranian crude exports returning to the global markets, in addition to other Saudi exports and other regional powers. Lower energy prices generally reduce inflationary pressure. However, I don't expect oil to collapse back towards $60 per barrel anytime soon. Global inventories remain tight, and many countries will double down on rebuilding their strategic reserves following the recent geopolitical disruptions. The latest events were a massive wake-up call to investors and governments everywhere. For now, lower oil prices will act as a modest tailwind for broader economic activity. And now on to stock-specific news. Nvidia announced plans to raise roughly $20 to $25 billion through the corporate debt markets. What's fascinating is Nvidia isn't raising the money because it's struggling or really needs the cash. The company is one of the most profitable businesses on the planet. Instead, this appears to be a strategic move. Every major technology company is fighting for dominance in artificial intelligence. Data centers, AI, infrastructure, networking equipment, and compute capacity all require enormous amounts of capital. The companies that can secure funding cheaply may ultimately gain a significant advantage over competitors. In many ways, this feels less like a traditional corporate financing move and more like an arms race, and Nvidia is making it very clear. It's prepared to spend aggressively to stay on top. Now, speaking of investor enthusiasm, few companies have captured the market's attention quite like SpaceX. Following its highly anticipated public debut last week, investors continue debating whether its valuations can be justified over the long term. As of today, the market cap sits at $2.5 trillion dollars and jostling with Amazon and Microsoft for a top 5 position based on market cap. The bullish argument is straightforward. SpaceX isn't simply a space company. Supporters believe it could become a dominant player in communications, satellite, infrastructure, defense, technology, cloud services, AI infrastructure, and global connectivity. The bear case is equally straightforward. A tremendous amount of future success is already reflected in today's valuations. When expectations become extremely high, execution has to be nearly flawless. Personally, I'm still watching from the sidelines. The company is undeniably impressive. The engineering is phenomenal. But investors are paying premium prices for future growth that has not fully materialized yet. And personally, I think much of SpaceX growth is tied to AI and computing, which basically makes it a very expensive Microsoft, Meta, or Amazon. September's earnings reports could become a major catalyst because investors will finally get a clear picture of whether operational results are keeping pace with expectations. Additionally, we'll also get some shares unlocked that could put downward pressure on the stocks. Turning back to central banks, today marked another major moment for monetary policy. Federal Reserve Chairman Kevin Warsh, in his first Fed chair meeting, announced that the committee would maintain rates at their current range of 3.5% to 3.75%. Now, the decision itself wasn't particularly surprising. What caught my attention was the broader messaging. Warsh indicated that the Federal Reserve tends to rely more heavily on incoming economic data and less on providing detailed forward guidance to markets. In other words, investors may receive fewer clues about what the Fed plans to do next. Personally, I think that's a healthy development. For years, markets have become obsessed with predicting what the Federal Reserve might think about future economic conditions. The result was a constant guessing game. What does the Fed think about inflation? What does the Fed think unemployment will do? What does the Fed think GDP will do? Instead, I'd much rather see markets focus on actual economic fundamentals and how that impacts the corporate environment, how that impacts corporate earnings, productivity growth, consumer spending, labor markets. Those are ultimately the factors that determine long-term wealth building creation, not the Fed's opinions on that. So for closing thoughts, where does that leave us all? Global liquidity is becoming tighter. The Bank of Japan is raising rates. The Federal Reserve is becoming less predictable. The AI arms race continues strong, and investors are trying to figure out whether companies like SpaceX can justify sky-high expectations. In other words, volatility isn't going away anytime soon. And that's perfectly fine because our strategy doesn't require us to predict tomorrow or next week. It requires us to consistently buy quality assets through both good markets and bad. When global liquidity shifts, the retail herd often panics and sells. Our strategy does the exact opposite. We continue accumulating, one share at a time, one day at a time. If you want to follow this portfolio's journey towards $1 million milestone, make sure to hit subscribe and please like this video. Drop a comment below and let me know what you think. Is the yen carry trade the biggest threat to the markets right now, or are investors overreacting? Remember, protect your lunch money, and I'll see you guys this Sunday for the full weekly portfolio update. Thank you.